Okay, welcome to another video, and in this edition we are going to be looking at again the weekly macro themes report. This is the one that goes to clients. It's from a few weeks ago, and what I wanted to do was a bit of a shorter video this time, but really just wanted to dive into a couple of charts on topic number 2 there, SLOOS scrutiny. So just scroll down to it. So here we go. And just a quick note on the layout or the format of this report. We have basically a bit of a write-up here, the bottom line, try to keep it as punchy and short as possible. One of the advantages I think should be that it's saving time rather than adding piles and piles to your reading list, and very much chart focused, so very much in line with the name, top-down charts. My view is that if you can't see it in the charts, there's probably not necessarily that much to talk about. And what we've got here is a good example, just a couple of charts and a bit of write-up, and then bringing it, of course, back to bringing it all together and producing a bit of insight in terms of how it ties into either the global economic outlook, regional outlooks, or indeed how it ties into asset allocation decisions, investments, and ultimately portfolios. So here we go. The bottom line for this one is, despite some slightly contradictory signals on the economy, and we'll get into that in a minute, the lending and credit surveys point to a solid economic activity, easy credit conditions, and a positive outlook for risk assets. Let's get into that. And so SLOOS, what does that stand for? The Senior Loan Officers Opinion Survey that's produced by the US Federal Reserve. It's a quarterly publication. It's basically going around and asking, as it says, the senior loan officers of the various banks, how they're seeing things. Are they tightening credit standards? Are they easing credit standards? Are they increasing the spread over the cost of funding? Or are they reducing that spread? And also, what kind of demand they're seeing in. But what I've found here is that there's a couple of ones that work quite well for understanding the risk environment. And for equities, or for the S&P 500 indeed, what you've got here is the net change in credit standards for large and medium firms, and that's actually shown inverted there. So when it's falling down like that, it's the bank's net tightening credit standards, and you can see there that whenever that goes below the zero line, it's typically pretty bad news. Now there was a bit of an orange or orange light there, or arguably a bit of a false signal. Certainly some sectors did get beaten up more than the headline index during that 2015-16 period, but it did provide a very good early warning signal, indeed a pretty good synopsis or prognosis of what was happening going into the financial crisis, and indeed even into the top of the dot-com boom. So this is really a key indicator, risk indicator that we watch, and certainly one that we'll be revisiting in the future with our clients. And the second one there shows very similar kind of dynamics, shows it versus US high yield credit spreads. And this one, rather than standards, this is showing you how the banks are changing their spread versus their cost of funding. And basically, if it's above that zero line, they're increasing the spread, and there's a few good reasons why they would do that. They would be doing that because they see risks going to the downside, or really they just want more compensation for the credit risk that they're taking on. And so that way, you can see it would make a lot of sense that it would line up with market-based credit spreads as well. And whenever you see one of these things start to move, it can provide some important signal. So you could see there that it started heading up into the spike, both during the dot-com top and also into the financial crisis. And it's also good to look for divergences there, because you could see that banks were they were not increasing their cost of funding while you had that spike there, so there was more of a sentiment driven one. And so that, that's another, very important one to watch. Where it is at the moment, it's come down to meet where credit spreads have fallen to, and there's no particular sort of warning signs there at this point. So that's why before I said, noted that points to a positive outlook for risk assets. But probably the two that I wanted to spend the most time on, and I think would be the key charts of this, is that whole contradictory element, because these surveys provide a good insight into some economic variables of what's going on in the economy as well. And again, I'll quickly note with these two that they it does line up with economic activity, and that's another index there, but I won't get into that on this video. What I'll talk about here is how these two charts are sending contradictory messages, because on the one hand you've got the commercial and industrial lending standards, which seem to be pointing to an acceleration in credit growth, loan growth, to commercial and industrial sector. And because there was that slowdown there, if you may recall, there was a lot of talk about that earlier in this year. How there was that slowdown in credit growth, even went slightly negative, and certainly that is something that you'd be watching for any signs of what's going on in the underlying economy, because credit growth is both impacted by what's going on in the economy, but it also is the fuel for the economy. Particularly during that the early mid 2000s, where the credit boom fueled sort of this period of above normal economic growth, and so it is really a key variable, and the fact that it's pointing to this acceleration there is it's a pretty good sign actually. But then on the other hand, you've got this one here which shows household credit card lending standards, which have actually been tightening up a bit. So you can see there that it actually has moved beyond the zero line. So that zero line there is actually for the growth rate of payrolls, and I'll get on to that in a second. But you can see there that the banks are actually net tightening household credit lending standards. So there may be other factors at work there. Maybe they're just tightening it from very easy levels. So there could be a reason, there could be other explanation for it. But at least from the year 2000, that particular series has had a pretty good link with payrolls growth, and this is from the non-farm payrolls survey. And you can see there that jobs growth had been running at a fairly good pace, but it has eased off in recent months, and that actually is lining up with what we're seeing here in this survey. So and I guess these are two different sectors of the economy. So on the right hand side, this chart is really dealing with the consumer sector, both on the jobs front and the credit card or the household lending front. And then on the left hand side, that chart really is dealing with the industrial sector or the business sector. So the fact that you've got two different things going on here, I mean, you can kind of reconcile that. May even reflect some of those bigger picture slow moving trends, such as the push where more jobs are becoming irrelevant due to technology. That could be having a slowing impact on jobs growth, but it is at odds with some of the other data that we're seeing, that the jobs market is actually tightening up quite a bit. And hey, one way to reconcile that would be that greater credit growth in the business sector reflects greater expenditure on capex. Maybe firms are thinking they'd rather spend money on getting machines to do the job than people, and that would be something that would be internally consistent with these two charts. Probably the biggest caveat there is that early 90s period where there was no relationship at all between the two series. So that's a good point to note there. And if I was intellectually dishonest, I would have cut that chart off around that 2000 period and wouldn't have shown you that. But it is worth showing you that because these relationships can break down. But I guess this really is one to be keeping an eye on. This one on the right hand side, to get an early warning sign on what comes next with the US economy, because if those credit card lending standards tighten up further in the next survey, um, at the moment it's just pointing to a slowdown rather than outright contraction. But if it slows down further, if those lending standards tighten up further, then that's going to be something to be concerned about. And certainly if payrolls growth, the other side of the coin, if that continues to slow down in line with where that's tracking, that's going to be something to keep an eye on. And if that starts to turn, then this relatively positive view on the risk asset outlook would also start to change. So that's probably where I'll stop at that point. And if you've got any questions or comments, if you've got any views, or if you want to put your interpretation up, please do go ahead and put it in the comments section below. And if you enjoyed this video, do go ahead and subscribe to the channel. It's probably the easiest way to keep up to date with the videos here. And otherwise, if you want to learn more about this report, just go through to the website. We're also pretty active on Twitter and LinkedIn. So thanks for watching.